In this video, we'll take a look at a profitable scalping strategy that combines our own premium trading edge indicators. Make sure to stick around until the end, so you understand the strategy and you learn how to get these indicators for free. Now let's roll the disclaimer and get right into it. Now, what you can see is the chart of Bitcoin US dollar tether on the 15-minute time frame. This strategy can also be traded on the 5-minute, which is what we usually use for our trading, but for the purpose of this video, and because these indicators work best on the 15-minute chart, that is what we are going to be using. Both of these indicators are momentum-based oscillators. The first one is the slower one, which we use for finding entries in the market, whilst the second one is a faster version that is used for getting out of the market at the best prices. The entry indicator is somewhat similar to the RSI. It has two zones, the overbought zone and the oversold zone. It can also create divergences with price, which can be a powerful entry signal. On the second indicator, you only need to watch out for the main plot line crossing the smoothing line, which gives profit-taking signals. It's also best to pair these two indicators with a 100-period moving average exponential. The EMA will then tell us the direction of the trend, so we know whether to long or to sell short. Now, as we have covered the indicators, we can get right into the trading rules of this strategy. There are essentially two ways to trade these indicators. Either track the divergences of the entry indicator or buy when it hits oversold and sell short when it hits overbought. We, however, like to trade both of these scenarios almost simultaneously, since each of them have their uses in different market conditions. When the market is flat and is trading within a range, whilst the EMA is somewhere in the middle of the price action, we like to use the overbought and oversold method. However, when price starts trending, the EMA is either below or above the price action and the market is making clear new higher highs or lows, the divergence strategy is the best, since it can tell us exactly when the market starts hitting a new top, is exhausted, and is ready to reverse. So for both longs and shorts, we first need to identify what kind of market are we in. After we've done that, we can start looking for entries. Let's first take a look at entering in a flat non-trending market. If we want to go long, we need to see the price go into the oversold zone. If this happens whilst the price is also retesting a previous low or a support zone, the better. After we have entered the trade, we want to place our stop below the previous low, and we want to start looking at the faster indicator for an exit. We will take our profit when the main line crosses the smoothing line to the downside, which essentially means that the bulls are getting weaker, and it's too risky to keep holding that position. For a short position, we need to see the indicator get into the overbought area. Also, if the price is retesting a previous high or a resistance zone, the better. It is always best to find confluence in trading. The more indications supporting your trade you find, the more people are probably looking to do the same. After we have sold short, we will place our stop just above the last high, and we'll start looking for an exit on the faster oscillator. We'll take our profit when the main plot crosses above the smoothing line. In trending markets, we will look for indicator and price divergences. For a long trade, we need to see a bullish divergence form. A lower low on the price chart, and a higher low on the indicator. After the second low has formed and a bullish candle is printed, we can go long. Our stop will be placed below the latest low, and as for our take profit, we'll use the same method as for the previous trades. You can also try using a predefined risk to reward ratio like 2:1, however you could be missing out on some solid gains. For a short position, we need to see form a bearish divergence. A higher high in price, and a lower low on the indicator. After the second high is formed and the price is starting to reverse, we'll sell short at the close of a bearish candlestick and apply the money management used in the previous trades. Now let me show you a couple more trading examples so you understand the strategy properly. Okay traders, I hope you have understood all the rules of the strategy, and now it's time to backtest it. If not, you can always go back and re-watch the video or drop your question down below. Now let's not waste any more time, and get into the backtesting. So as you can see, we've finished with the backtests and the results are pretty solid. We have made 200 trades in the span of about 8 months, and the account has grown by an incredible 578%. The win rate of the strategy is 82%. However, you still need to consider spreads and fees when trading live, but the strategy will definitely still deliver. Now, if you have stayed this far, let me show you how to get the indicators. You simply need to type TE entries and TE exits into the Indicators tab and you should be able to use them for free. Feel free to play around with them on different timeframes as well as with different settings. Also, if you are new to this channel and you are an aspiring trader, definitely consider subscribing, because there are many more great trading videos coming that you don't want to miss. And if you have a strategy or an indicator that you would like us to check out, then comment below. With that said, I wish you all the best in your trading journey, stay true to your trading edge, and I will see you next time.